We're approaching a critical period in Group's Pillar 2 journeys, with the rules coming into force shortly in the UK and in many other countries. Now, this naturally means that many groups are moving on from their impact assessment and technical analysis phases of work, and they're really starting to think about the practicalities of how they're going to manage Pillar 2, so the reporting and the compliance obligations. So with that in mind, I'm joined by Richard and Kevin from our Global Compliance and Transformation Group to discuss this. Richard, you're our lead on reporting. So clearly there's a lot of actions for groups to think about before they go into the new regime. Can you just give us an outline of some of these?
Yes, sure. So groups need to engage with auditors, first and foremost. The rules are enacted in the UK, but not yet in force. So they need to use this time to get the impact assessments ready to support the disclosures that are required for calendar year ends in 2023. So what elements of the impact assessment are groups thinking about? Firstly, the data, so making sure whether they use actuals or forecasts, how they validate that. The technology, so they may be thinking about technology for Pillar 2 more generally, but at this stage, something like touch to meet the obligations. Also, what is in the disclosure? What qualitative and quantitative information within the framework are they going to disclose? And thinking about what are the relevant stakeholders for their business to be able to make that assessment. So in summary, groups should engage with their auditors, think about what data they need, and get the impact assessment done.
And Kevin, groups must be thinking about a different approach from a compliance readiness perspective.
Yeah, absolutely. And obviously there's a longer time frame or lead time before the first compliance filings fall due. But I would say there are three critical things that groups are looking at this point in time from a compliance readiness standpoint. The first is actually thinking about their target operating model for Pillar 2 compliance. So do they want to insource the calculation and filing? Do they want to outsource it? Or do they want some form of mixed model, co-sourcing type arrangement? And that's then leading groups onto a natural second question, which builds on Richard's point around technology. There's lots of Pillar 2 technology coming onto the market at the moment, all with different features and functionalities and objectives. Our KBAT solution, or KPMG BEPS automation technology, is being designed to support the end-to-end Pillar 2 compliance journey, from safe harbours, election management, detailed calculations, global information return, production and filing. So it's going to cover all aspects of Pillar 2 management for groups. And then finally, technology isn't a silver bullet. Groups are still grappling with the data challenge that Pillar 2 represents. So lots of groups are looking at taking this time to implement a data staging solution, like a data lake or a data warehouse, to make sure they've got ready access to the information they need to support reporting, to support compliance, to support modelling, forecasting and other tax activities in respect of Pillar 2 at the touch of a button, bringing information from across the organisation. And that's especially important given the domestic minimum top-up tax implementations that we're now seeing around the world, because consistency is now key.
That's right. I mean, we are seeing a lot of countries adopting their qualifying domestic minimum top-up tax regimes. Is that going to simplify compliance at all?
Absolutely not. Absolutely not, Cash. So it's actually shifting the burden from what was going to be a centrally controlled calculation that could be performed by a group team using a consistent data set, to calculations that now need to be done locally, filed locally, and sometimes performed on a slightly nuanced basis from a data and calculation perspective. So it's increasing complexity. And if the domestic minimum top-up tax isn't qualifying, actually you need to do two calculations. You'd need to do a calculation locally and a calculation centrally, because you wouldn't be able to take advantage of the safe harbour. So actually it's potentially really increasing complexity for groups.
Yeah, there's a lot of complexity with these QDMTT rules and how they all interact. And then from a reporting perspective, I think for tax leaders looking ahead towards the end of the year, Richard, what are the key priorities for them, and where do you think they need to be at the end of this year?
Yes, so at the end of this year, groups need to have the systems and processes in place to start being able to have materially accurate top-up tax accrual, most likely for external publication in half year 2024. So taking one part of the calculation, such as deferred tax, they need to think about the granularity and the accuracy in their current tax reporting system, and is that now fit for purpose when they need to use and adjust this number in a different way than they have before. Also, thinking about the controls and the documentation of those controls. This major use tax has a huge impact on the financial control environment, and that needs to be documented. Also, the right controls and documentation will help support reasonable measures to demonstrate to HMRC during the safe harbour period that they have done what is required in relation to Pillar 2.
Yeah, there's a lot there to get ready for. And I think it's clear that, as the final pieces of the policy jigsaw that make up Pillar 2 are falling into place, there's a lot there from a compliance and a reporting perspective for groups really to get involved in managing for the rest of this year and indeed for next year during this transitional period. So thank you very much, Richard and Kevin, for your practical insights. Appreciate it.